Well, to get a perspective of what this means to the world, should the world be worried? Should politicians, who would be looking at this, especially between the Democrats and Republicans, how would they play this out? To get a perspective of all this, and should India too be concerned about this particular exposure that's taken place? Dr. Nilanjan Manik, senior economist, joining us this evening on News Connect. Let me welcome you. Let me begin by asking, an abrupt collapse of two US banks there. Should entrepreneurs and also politicians be worried about this?
Okay, let me give you the background as to what is happening. Let me step 3 years back when we have had COVID. At that point of time, what happened was the US government, they spent close to $1.5 trillion. Now, to put into perspective, the size of the Indian economy is $3 trillion. Almost half that amount the US government were spending to save the economy from COVID. And mind you, over in the US, what actually happens is you have a generous social security payment. So even if you are not working, what it implies is the people over there, they were getting money from the government. So there were no addition to the real sector of the economy. You are getting money from the government, which actually eventually led to inflation, which we have seen crossing almost 40 years high. Now that has led to the Fed as what we see at this point of time, in particular during the course of last year, increasing the Fed rate because their inflation rate in the US, it crossed 8% level, whereas the Fed, they wanted to keep the inflation level at 2 percentage point level. Now, because of that, over a period of time, in particular during the course of last year, what we have seen that the Fed continuously increasing the rate. Now, this has led to what we call the inverted yield curve. Inverted yield curve basically means your long-term bond yield is actually becoming less than the short-term bond yield. Now, this is kind of peculiar because if you as an investor want to put your money in bank, typically what you would expect is if you are, let's say, putting your money for 5 years or 4 years, the rate of return on your fixed deposit will be generally higher than what you would expect to get for 1 year. But when you have an inverted bond yield, basically it means that your short-term rate of interest is actually higher than the long-term rate of interest, which is a peculiar scenario because if I were to give you the data at this point of time, the long-term 10 years bond yield for the US economy is around 3.8 percentage point, whereas the short-term bond yield is around 4.8 percentage point. Now, what does that mean? It means that because now the rate of interest has gone up, the cost of capital has gone up. And because the cost of capital has gone up, what it means that the profitability, the present discounted value of future return from any business activity, it is going to go down because your rate of interest has gone up, which means the cost of capital has gone up, which also means the present discounted value of your future earning has also come down because your rate of interest, short-term rate of interest has gone up. Again, why the short-term rate of interest has gone up? Because US is facing inflation which has not happened over the last few decades. Now, in order to control that, Fed is increasing the rate of interest, and in doing so, the short-term rate is going up. Now, what we have seen yesterday with respect to this Silicon Valley Bank, they were actually lending money to the tech startups. Now, during the COVID times, what was happening, most of us were working online, and therefore you see all the tech companies, in particular Facebook or even in case of India, TCS, Infosys, their market share, their return actually went up because people were using online data for a bigger amount of time. But after COVID, after the economy opened up, people are not so much using the online data which they were using before. And because of that, we have also seen all the layoffs which were happening in the context of Google or in the context of Facebook, Metaverse, so on and so forth, which is basically suggesting that because the economy has opened up, people are now going from the online mode to the offline mode. Now, to put things into perspective, now what has happened in the context of SVB Bank, which is Silicon Valley Bank, they lost close to 1.75 billion US dollar. Now, to put it again into perspective, $1.75 billion is equivalent to almost 14,000 crore, lakh of crore rupees, which is actually more than the budgetary outlay which the Indian government is doing on account of building infrastructure. Because in the last budget, we have seen the finance minister allocated 10 lakh crore rupees. Now, why they actually made so much of loss? This is again to do with the short-term rise in the rate of interest, which kind of impacted the profitability of the tech startups, and therefore the valuation of the business for which SVB Bank has given money has come down. And because the valuation has come down in the book of account, the SVB, the Silicon Valley Bank, has made so much of losses. So just to tell you what is happening now, because you see that the rate of Fed is keeping on increasing the interest rate, and I don't think they are going to stop anytime soon, because even if you look into the job market data which came out yesterday, it is still showing strong. So in spite of the GDP not doing that great, because in the US, they also take into account consumer confidence index as well as the job market data. So these other two factors are now showing strong because they have opened up the economy. People have started coming out for work. And because of this, the US economy is technically not into recession, because in the US, unlike in major other countries, they also take into account, in addition to the GDP growth numbers, few other factors, namely the consumer confidence index and the job market data. So because of that, we see that the Fed is again going to increase the rate of interest, which is indirectly going to hurt. Because if you think in a very simple term, if my short-term rate of interest is inching towards 6% or 5.5%, that means for a common people to take loan, I have to shell out almost 6 or 7 or 8%, which is kind of unheard in the US economy. So I hope that the economy does not actually, because the Fed want to control inflation, they don't push the economy towards recession.
Okay. Dr. Banik, when one looks at any kind of financial crisis that hits the market today, everyone goes into referring to history mode and talks about the 2008 financial crisis. Do you see a likelihood of that getting repeated, or this seems to be not on the same lines?
Yeah, so one similarity between 2008 and what we are seeing right now is the inverted bond yield, something I mentioned, which is the long-term rate is lower than the short-term rate. But in the 2008, what happened, it actually originated from the real estate sector. And that type of thing I don't think is going to happen at this point of time, because what is happening at this point of time, the increase in rate is happening because the US Fed is firefighting to stop the additional bout of inflation. Now that has some implication for a growing, a large economy like India, because as the US Fed increases the rate, typically what happens is the investor, the foreign institutional investor, they tend to take money away from the emerging economy to the more developed countries like North American economy, or for that matter, European economy. Now that is a cause of concern, because if RBI also do not increase the interest rate in tandem to what the Fed is doing, we are going to settle down for a depreciating rupee, which is not a good news for a country like India, because that also have an indirect impact on our inflation.
Okay, Dr. Banik, the collapse of the Silicon Valley, and you made a mention about Indian startups too that have benefited immensely from it. So is there a cause of concern, especially for Indian startups, looking at the way ahead?
In a way, yes, because now our startup system has become very much matured. We are strong, almost 3 lakh crore rupees. And in the case of startup, it has more to do with the business model. Now, the thing which has happened in the context of the US, as I said, that this SVB bank, they were lending to the tech type of startups. But in India, you see a majority of the startup are also operating in the non-tech domain. For instance, in the healthcare sector, in the recreation sector, in the hotel sector, in the transport sector. So, which I think is is going to put our startup system more resilient. But having said that, my only worry is if the rate of interest keep on rising in the developed countries, in particular in the US, people are going to actually take my money from developing countries, even though it's a large, fastest growing economy. You are going to see the foreign institutional investor taking away money from economies like India, which may sound a bad news for a startup like in India.
Okay, the SVB collapse came about, roughly around Friday afternoon, especially in the Indian markets. We didn't see much of burn in the Indian markets there on Friday. But do you see the likelihood of this being more a sentimental story is how the Indian markets would react, or would you see the Indian markets there getting into a bear grip or into a bear grip there on, coming week?
No, in a way, we have seen the Indian stock market. If you look into the dollar return, because there is two ways to look into the stock market return. One is the rupee return, the other is the dollar return. Now, if I'm looking into the dollar index return for the Indian stock market, we are actually have not performed well since last 1.5 years. In fact, I was just looking at the data since 2000, we are now in 2023. Since July of 2021, when our market reached 18,000 Nifty, I'm talking about, right now, even after 1.5 years, we are again in the territory between 16,000 to 18,000. So in a way, the Indian investor, they have lost their money, and in particular, if you are indexing that, and our rupee has also depreciated. So if I look into in the US dollar term, we have lost our money, and for the last 1.5 years, the FIIs, they were continuously selling in the Indian market. Probably they have seen this thing coming, because of which they have become a little bit cautious. But on an optimistic note, the 2/3 of the India's GDP is actually run by the domestic economy, run by the domestic demand, which is basically to say that our economy is resilient no matter what happens elsewhere in the world. And Indian economy, although the stock market is seeing a little bit of fall, but in the near future term, which is within a year from now, I think we will be back to 18,000 plus level.
Okay, when one looks at especially the Indian markets, you made a mention about high interest rates or the high interest rate regime that's come into play. But when one looks at the Indian banks and the numbers that they have shown, especially in Q3, the numbers seem to be pretty positive. So in that context, how do you see this? On one end, there is a fear that the hawkish approach that Jeremy Powell is making is having a deep impact across the globe. But on the reversal side, banks seem to be showing pretty strong numbers, especially with the high interest rates that have been maintained.
So you also have to recognize one thing, which is the digitization which is happening in the context of Indian economy. Now, if you want to see what has happened as a percentage of financial transaction, as a percentage of GDP since 2012, we have quadrupled in terms of the number of transactions which is happening through either UPI, either PhonePe or GPay of the world. So what basically it means that because you have so much of digitization happening in India, the rural market, the small MSME sector, they are getting increasingly involved in formal business. And that has led to the bank doing a better, more risk-averse type of business, because all these sectors which were outside the ambit of the formal banking system, thanks to our digital economy, thanks to our UPI system in place, they are now actually coming under the ambit of the real economy. And that is creating an economy which is the system.
One final word before I let you go. A bank is in trouble. Investors start fearing, or they get perturbed with the developments that happen around them. But somewhere deep down, looking at it from an investor point of view, is there cause of concern for an investor when he looks at his portfolio with this particular development that's taken place?
So when we are talking about the investor, there are two types of investor. The first is whether I'm investing in the stock market, and the second type of investor is whether I'm investing in the real sector of the economy.
Okay.
Now, what I've mentioned a few minutes back, in India, 2/3 of our GDP is actually driven by the domestic demand. And most part of it has to do with the non-tradable services sector like healthcare, education, transport, logistics, so on and so forth. Now, the Indian economy is doing very well in terms of the growth, and we have seen it is the fastest growing large economy in the world. So if I were to invest in startups which are operating in the Indian ecosystem, as an investor, I will put my money. But if I am trying to be a punter, want to make quick money from the stock market, I rather shy away from that activity for the time being. But I still believe within 1 year from now, the Nifty is going to cross 18,000 marks.
Okay, we'll leave it on that point of optimism that you put together there, Dr. Nilanjan Manika. Thank you and appreciate you joining us, explaining it threadbare to our audience on what this particular Silicon Valley Bank and the closure of it means there for the rest of the world. Thank you once again.
Thank you. Thank you.